We usually treat macroeconomic cycles like dry, boring academic theory. But what if we looked at them through the survival-focused lens of a seasoned investor? Suddenly, the hidden mechanics behind all those booms, busts, and everything in between, well, they stop looking like a chaotic roller coaster and they start looking completely predictable. Welcome to our explainer on decoding the debt cycle. Let's jump right in. Think about it. Whenever a financial crash happens, the headlines always paint it as this sudden, unpredictable hurricane, right? Like a massive shock to the system that literally nobody could have seen coming. But is that actually true? Are these economic shocks really unavoidable natural disasters? Well, to figure that out, we've got to look past the panic and really examine the underlying nuts and bolts of how money and credit actually flow through our society over time. Billionaire investor Ray Dalio has this great way of putting it. He says watching the economy is basically like standing in the middle of a massive, ever-changing blizzard. You've got millions of data points, screaming headlines, policy shifts, and price ticks just swirling all around you. On a day-to-day basis, it is completely overwhelming. But here's the secret. Once you step back and aggregate all those data points over a few decades, you realize this blizzard, it isn't random at all. It actually follows highly logical, repeating, and entirely predictable patterns. So to clear away that blizzard today, we're going to break this dense economic beast down into 6 logical pieces. First, demystifying debt crises. Then, the truth about credit. The monopoly game analogy. When the bubble bursts. 4 tools for policymakers. And finally, the long-term debt cycle. All right, part 1, demystifying debt crises and finding those hidden patterns. This whole framework actually comes directly from Dalio's massive research project, detailed in his book, Big Debt Crises. The guy didn't just accept conventional macroeconomic wisdom. No, he went back and meticulously studied 48 different historical debt crises to build a reliable, predictive model. We're talking deep dives into things like the Weimar Republic's hyperinflation in the 1920s, or the incredibly complex mechanics of the Great Depression in the 30s. His firm mapped out the exact DNA of a financial collapse. And this wasn't just some academic exercise for fun. It allowed them to build a literal depression gauge to successfully anticipate the devastating 2008 financial crisis. Because they really understood the underlying mechanics, they knew exactly what to look for right before the storm hit. They protected their assets and even profited while countless others lost everything. Okay, moving to part 2. The truth about credit, which really is a dual-edged sword. Look, credit gets a terrible reputation after a crash. We tend to look at all debt as inherently dangerous, right? Just a liability that eventually leads to ruin. But actually, starving an economy of credit means missing out on absolutely crucial development opportunities. We really have to weigh the first-order consequences against the second-order consequences. Imagine you're a policymaker, and you decide to build a massive $1 billion subway system funded entirely by debt. Now, let's say the project underperforms, and 40% of that loan is just effectively lost. That sounds totally catastrophic in the short term. But if total debt is 200% of GDP, that bad debt only equals about 16% of GDP. Here is where the macroeconomic magic happens. If you restructure and spread that loss out over 15 years, it results in a highly manageable 1% hit to GDP per year. So compared to the massive compounding long-term economic and social benefits of actually having a functioning modern subway system, that short-term cost is totally worth it. The true danger isn't the debt itself. It's the inability to spread out the pain of bad debt. Part 3, the monopoly game analogy and the rules of the macroeconomy. Now, what's really cool is how we can map these super dense sovereign debt concepts onto a board game we have all played, Monopoly. Think about how a standard game naturally progresses. Early on, everyone's got cash, very few properties, so it pays to aggressively convert your cash into hard assets. In this phase, property is king. You want your money out there working for you on the board. But as the game goes on, more properties are bought up, developed, and suddenly landing on them requires more and more cash to pay rent. Eventually, players run out of liquid money and they are forced to sell their properties at massive discounts just to survive. Boom, the paradigm shifts and suddenly, cash is king. Now, imagine if Monopoly allowed you to borrow money from a bank to buy hotels. That borrowing massively accelerates the property buying, pumping up a huge rapid bubble. But it also guarantees that the inevitable cash crunch will be so much more severe because players have to service that debt on top of paying their regular rent. This mechanical transition, from cash-rich expansion straight into a debt-burdened liquidation, it literally mirrors our real-world economy perfectly. Which brings us to part 4, when the bubble bursts and the self-reinforcing drop.
So what actually happens when this real-world game of Monopoly accelerates too fast and smashes into the economic ceiling? Well, during the boom phase, we see this powerful, self-reinforcing cycle. When you borrow and spend, your spending immediately becomes someone else's income. And because their income goes up, they look more creditworthy to banks. Lenders actually get super complacent during this phase because all the underlying asset values are inflating, which makes it super easy to justify riskier and riskier loans. So the banks lend out even more money, which gets spent, driving asset prices even higher. It's wild. Human psychology plays a massive role here too. We naturally prefer to borrow, consume, and expand, rather than, pay things back and contract. And all of this creates a psychological bubble where everyone, from the average consumer all the way up to giant institutional lenders, honestly expects this debt-fueled growth trajectory to just last forever.
But here is the turning point. The exact moment the economic cycle reverses is when the cash needed just to pay the interest on all that accumulated debt finally outpaces the actual income coming in. When you reach a stage where you can't even borrow enough just to cover your existing debt payments, spending absolutely must be cut. And remember that golden rule? Your spending is someone else's income. So, as spending drops, incomes drop across the board. Asset values plummet, lenders panic and tighten credit, and the entire self-reinforcing cycle violently slams into reverse. This is the painful liquidation phase. Part 5, 4 Tools for Policymakers. Let's call these the Game Master's cheat codes. The good news is, when the cycle reverses, total collapse isn't completely inevitable. Why? Because we have game masters, these central banks and fiscal policymakers. As long as a country's debt is denominated in its own local currency, these game masters have 4 specific levers they can pull to spread out the pain and keep the whole system from breaking down completely. Number 1 is austerity, which basically means aggressively cutting government and private spending. Number 2 is debt default or restructuring. This is where creditors legally agree to be paid back less than they're owed, or maybe over a much longer time frame. Number 3, the central bank can literally print money and engage in asset purchases to inject fresh liquidity into the system. And finally, number 4 is wealth transfer. This is usually done through taxation, taking from the wealthy to support the broader struggling system. Now, balancing these 4 tools is an incredibly delicate act. Austerity, defaults, and wealth transfers are highly deflationary. They successfully reduce the overall debt burden, sure, but they are incredibly painful for the economy, leading to mass job losses and bankruptcies. On the flip side, printing money is inflationary. It stimulates growth and provides this nice, immediate relief, but you risk drastically devaluing the currency and sparking runaway hyperinflation. So the ultimate goal of any policymaker is to perfectly balance these painful deflationary tools with the stimulating inflationary ones. They want to engineer what Dalio famously calls a beautiful deleveraging. It's a really rare and super difficult maneuver, but if they hit the nail on the head and get the mix right, the overall debt-to-income ratio goes down while the economy still manages to maintain positive growth. Finally, Part 6, the long-term debt cycle. This is what happens when you run out of ammunition. Everything we've discussed so far really applies to short-term business cycles. Those familiar booms and busts that happen roughly every 5 to 10 years. But take a look at this chart. You can literally see what happens when these short-term cycles stack up over decades. Notice how total debt relative to the economy just keeps climbing, cycle after cycle, and yet the overall interest burden stays relatively flat? That happens because central banks consistently step in to lower interest rates, making it cheaper to service that massive mountain of debt, which keeps the game going. But I want to draw your attention to the critical danger zone on the right side of this timeline. When interest rates finally hit that 0% bound, the central bank has officially run out of its primary ammunition. They literally cannot lower rates any farther to stimulate borrowing without stepping into bizarre negative rate territory. This zero-bound limit, it forces a huge reckoning. It's the moment when a massive long-term deleveraging absolutely must begin, and those standard cheat codes we talked about just don't work the way they used to. So, keeping all of this in mind, these mechanical cycles of credit, expansion, and the very finite tools available to central banks, where do you think we are in the game right now? Seriously, take a close look at your own credit cards. Look at today's macroeconomic headlines. Watch what's happening with interest rates right now. Understanding this framework doesn't just make you a better observer of the economy, it actively prepares you for whatever part of the cycle inevitably comes next. Keep your eyes on the data.